So, a lot of students and subscribers have been asking me about the volume filter. So, I just wanted to make this quick video about volume. This is extremely important. Please pay attention to what I'm saying. This is going to affect your trading performance. Okay, so yeah, you have to concentrate on what I'm saying here. So, average daily volume. Just a second. Let me grab a pen here. Okay, so average daily volume. What is average daily volume? Well, the blue line that you see on the chart, so this is Dixon. So the blue line that you see on this chart, this is the average daily volume. So this is the 50 period average daily volume line. So you go back 50 days and you check these volume bars, you add up all those volume bars and divide by 50. That's your average daily volume. And that's the moving average because every day uh, continues to unfold. That line uh, keeps going further. Okay. So this is the average daily volume. So see, currently the average daily volume for the stock is, you look here, this is the blue line. It is 697K. So 697,000 shares traded on an average per day for this stock. So this is the average daily volume I am talking about. So what I do is I divide the entire stock market into three different buckets. One is where the average daily volume is more than 200,000 shares. Second is the average daily volume is between 100,000 and 200,000 shares. And third is less than 100,000 shares. So why is this important? Why is it that before you take a position in a stock, you should look at the average daily volume of the stock? Well, the reason is the daily average daily volume tells you about the personality of the stock. You understand what you are dealing with here. So, for example, if a stock has more than or equal to 200,000 average daily volume, that's the number of shares traded per day on an average. It means that it's a liquid stock. The risk in this stock is low. You can easily glide in and glide out of the stock. Imagine that you are a fund manager and you have millions of dollars to plow in the stock market. So even if you take a small 1% or a 5% position, that is going to represent a huge amount, okay, in absolute terms. So you need adequate volume in the stock that you are buying so that the price doesn't get distorted. Your purchase could make a huge difference to the price of the stock if the volume in the stock is very low. Imagine a stock that trades 10,000 shares per day and you put in an order to buy a million shares. Okay, that is going to significantly affect the price. So imagine that you are a fund manager and you have millions of dollars to invest and trade. So this is the area which is safe to operate. I call this the safe zone. The more the liquid the stock, the better it is for us as traders. It is easy to glide in and glide out. Even Patrick Walker, who is a veteran trader with more than four decades of trading experience, he has also said in his interview that you stick to stocks which trade at least 200,000 shares per day. So this is the safe zone. So higher the volume, lower is the risk of being shaken out. Higher the volume, lower is the volatility. So preferably operate in this zone. This single filter itself will reject a lot of stocks in the stock market, especially Indian stock market, also the US stock market, because there are a lot of illiquid stocks in India. Okay, so if I have, let's say, if I put the Mark Minervini filter, let's say I get 800 stocks and I put this filter, that 800 list suddenly becomes 300. So can you imagine how powerful this filter is? So it will keep me in the safe zone, in the safe territory. Okay, it is not easy to manipulate these kind of stocks because greater than 200,000 shares means there are many stocks which trade millions of shares per day. So that falls in this bucket. Now let's go to this bucket. Less than 100,000 shares traded. So if you are a beginner, okay, don't even go here. This is the most dangerous territory. This is where stocks could get manipulated. A large player could come in, spike up the price, you buy shares, to increase the price, and suddenly the price drops. So there is a lot of volatility. You can get shaken out. So if you are a beginner, if you are just 1 year, 2 years into applying or learning this breakout trading system, please stay away from that zone. So when you put the filter, just make sure that you are only buying stocks with at least 100,000 shares traded per day. Now, if you are an advanced trader, you have some experience, then you know that there is risk in this stock. You already know that the win rate or the success rate in this is going to be low. So, how do you compensate for that? Well, in this category, you only look for stocks with very high relative strength. So, relative strength of 90 or more, and industry group rank of within 1 to 40. So, you are compensating that liquidity risk by going into stocks which are already showing strong relative strength and strong industry group rank. Okay, so that's one way to manage risk. So if you have chosen voluntarily to take that much risk, you can adjust for that risk, or you can compensate for that risk by only going into stocks with high relative strength and high proper industry group rank. But imagine if the relative strength of the stock is 72, industry group rank is, say, for example, 94, which is poor, okay, it's below 40. And more on top of that, the industry group rank has been worsening, and you are trading a stock with less than 100,000 shares, then God help you. Okay, so please understand the risk involved. There is something called as liquidity risk. So we have to be aware of that. I am not saying don't trade these shares. I am just saying that if you choose to trade these shares, you need some way of compensating for the additional risk that you're taking, or maybe go in with a small position size. If your normal position size is 10 to 15%, and if you're buying this stock, then your position size in this should be 5 to 7%. That's another way to control risk, or you keep a tight stop loss, whatever you do, but just go in with the awareness that you're taking additional risk. Then comes the middle part, 100,000 to 200,000 shares. Well, obviously, the risk here is lower than the risk here relatively. However, the risk here is higher than the risk you have here on a relative basis. Okay. So, as you go from here to here, the liquidity increases and the risk decreases. Okay. So, now you are in this middle spot. Again, there is risk in this also, but you can compensate for that risk by going for high relative strength stocks, good industry group rank, improving industry group rank. The more closer the stock is to 200,000, the better it is. Recently, I bought a stock which is Polymedicure, which falls in this category. See, 189,000 shares traded. If you see here, 189,000 shares traded per day. And I bought the stock here. So I was managing my risk. I was aware that I need to micromanage this trade. So that this is one stock. Then there was another which I took and I lost money, which came in the first bucket. See, 87,000 shares traded per day. So that came in this category. Okay. So risk. I lost money when I invested here. I made profit when I invested here. And Dixon, if you know, Dixon, 697,000 shares traded, it comes in this category. Dixon, I made money. Polymedicure, I have booked profit, moved my stop loss to break even. So you understand what I'm saying. As a beginner, preferably operate here. Okay, once you spend 1 or 2 years, then you go to this bracket. And after that, once you spend nice 3, 4 years, then you go to this bracket. That is how your natural transition should be. As your experience grows, you are eligible to take more and more risk in your portfolio, because now you know how to manage that risk. So I hope this answers your question. A lot of subscribers and students were confused about volume and whether it is an important factor in our breakout trading system. Of course it is. Okay, even stocks with 200,000 shares traded, more than 200,000 shares traded, could display volatility. So look at Dixon. Look at this volatile candle. Okay, that's a stock with more than a million, more than 500,000 shares traded per day. But still, look at the volatility. So there is going to be volatility, but the probability of volatility is very low. See, this candle came after so many small candles. Okay, so the probability of volatility decreases as you go from here to here. So I hope this video has added value to your trading journey. Thank you so much for your support on this channel. Thank you so much for your time. Please like, comment, and share this video so that this video will reach those people who genuinely want to become professional stock traders just like you. Thank you so much. I will see you tomorrow in the next video.